Hi there. This is an OCR 585 short on the importance of trade for developing countries. Trade figures very prominently in extracts 1 and 3 in particular of the June 2016 pre-release syllabus. So why is trade important for developing countries? Well, of course, for many nations, successful exporting of goods and services is a way of generating export revenues, those all-important foreign currencies, perhaps dollars and yuan and yen and euros. And successful trade is a way of lifting many people out of extreme poverty. So countries such as South Korea and China and India, through their trade, have reduced poverty substantially. Trade can also be seen as a supply-side policy, a way of increasing the scale and the intensity of competition in markets, which could then in theory lower the real price level for goods and services and increase people's real incomes. And trade oftentimes leads to better access to new technologies which can raise productivity. So for example, a developing country might use some of the revenue from selling primary products to import essential capital equipment. Trade, of course, can involve the movement of goods and services and people across borders. So things like knowledge spillovers can lead to technology transfers and improve the stock of human capital. And businesses that are looking to trade outside their national borders, beyond their domestic markets, may try to exploit economies of scale, which of course brings down the unit cost and the price of products. You can also make a case for saying that trade is a way of making better use of scarce resources. And increasingly, we're seeing that developing countries in particular are becoming more expert in developing and then exporting renewable technologies, including to developed nations. So why is trade important? Well, here are some key points. Trade is vital in terms of sourcing foreign currency. Foreign currency is both an inflow into the circular flow of income and spending, but also, of course, it helps the current account of the balance of payments. Lots of good examples of developing countries that have done well on trade, sometimes accumulated trade surpluses and built up a stock of foreign currency reserves. Trade is an important way of financing the key things that one has to import at different stages of development. For example, essential energy or capital equipment. And at a basic macroeconomic level, successful exporting is both an injection of demand into the circular flow in its own right, but of course can then lead to positive multiplier and accelerator effects. For example, as export industries grow, you employ more people, increased flow of demand for export supply industries such as logistics and transport. Trade can increase employment, particularly in export sectors and related industries. And per capita incomes can increase as a result, and hopefully the extra per capita income feeds through to a stronger HDI performance. And trade can also bring down the price for consumers, particularly if you open up a market to competition. So these are some of the static and the dynamic effects of successful trade for developing countries. But of course, trade is not without risk. Keep in mind before we move on to those risks that if we take the least developed countries, not less developed, but the least developed countries in the world, their share of total trade in goods and services was only 0.5% in 1995 and just 1.1% in 2014. So in many cases, for the least developed countries, there is a huge amount of trade potential, but at the moment they're not really scaling up their production. What are the dangers? What are the downsides? What are the risks of opening up markets to trade and investment for developing countries? Well, one of the issues, of course, which we discuss in Extract 3 is the primary product dependence problem and the natural resource curse. That many countries are exporting only a narrow range of products, and of course their export markets, their revenues, their employment, their profits are highly exposed to volatile global prices, volatile economic shocks. Equally, the export sectors can be affected by geopolitical uncertainty and big cyclical shifts in demand. A lot of developing countries, as we find out in Extract 4, are increasingly reliant on inflows of foreign direct investment. FDI now the biggest single source of external finance for developing countries. But whilst capital flows are important, they're also volatile. Capital is footloose, can often move around very quickly. There's also a danger that if you open up your markets to trade and investment, in some cases, you might actually cause rising unemployment. So new firms come in, new businesses arrive into your economy, and can threaten established businesses, established jobs, and the pattern of demand and output will change over time. Some countries, in fact, decide to protect their economies, certainly whilst they're going through the early stages of rapid industrialization. That's called import substitution policies. So different forms of protectionism, including tariffs and quotas. And eventually they may open up their markets once their domestic businesses are sufficiently scaled and sufficiently competitive. Point 5 is specific, I suppose, to a number of countries, and Zambia, I suppose, will be one of those nations, that countries that specialise in only a few natural resources. There's a risk of over-specialisation in those industries, and of course they could suffer from the natural resource trap. We'll cover that in a separate video. So there we go, just a few thoughts, an OCR 585 short on the importance of trade.